Hi everyone, we are really happy to welcome you on our Macro Break webinar, the place where we are sharing updates about the latest news in economics, finance and investments. Today we are going to discuss whether the rotation transition are already priced in, and also we will cover the Thematic and USD updates. For this, I'm really glad to present to you our two speakers, the experts in finance and global financial markets, Jacques Lemoisson, founder and CEO of Gate Advisory, and Jay Pelosky, founder and CIO of TPW Advisory. So before I pass the word to our speakers, I would like to remind that this webinar is hosted by Quantilia, the data management and analytics platform dedicated to wealth managers and institutional investors. As usual, during the whole webinar, you can post all your questions through the system via chat, and we will answer them at the end. So let's get it started, and I leave the stage to Jacques and Jay, please.
Thank you, Katerina. Thanks for hosting us. Hey, Jay, how are you?
Good, Jacques. Thank you, Katerina, and always great to
yes,
be
welcome.
Here.
Always pleasure to have you there.
Jay, I think that's it. Before to just start, I would like to highlight that we have an amazing timing for our webinar. Last time it just was the day after the presentation of the Biden infrastructure plan. Now we are just a couple of days. We had a very strange NFP figure plus the hack targeting Colonial. I don't know if it's. I hope that we will have always the same timing, man.
Yes, indeed. It's always. I think our topics are right on point, and I know you've put some slides together. And I want to say, Jacques, congratulations! I believe you just launched your U.S. infrastructure certificate at Gate Advisory. So I wanted to congratulate you on that, and look forward to digging into the slides here. I know we've got a lot to cover.
Yeah, thank you very much. Yes, it's a great achievement for us. The first certificate, we advised the index. We are reaching $10 million for the launch. And we are very proud of that. And it's just the beginning, but it's a good start. And now, okay, where are we in the transitions? The last time together, we just tried to depict what could be the transition, okay, from a world in the COVID to an economy and society post-COVID, or try to be post-COVID. Now, where I think that the pillar of this transition is vaccination. Okay, definitely now some countries are more in advance than the others. As usual, Europe is laggard, but also some emerging markets, or mainly also Brazil and India are laggards, but also they are the hub, I should say, of some nasty variants. The Brazilian variants and the Indian variants are very nasty. But this just charts us the reality, okay? Some countries are closer and closer of herd immunity. This is why I think the transition could happen this summer. I think we are together quite aligned with that. Now the vaccination now is normally slowing in the US. Now I think the US should reach the herd immunity this summer, but we are already the 30% of populations reacting against the vaccinations. I think it would be a huge achievement if Biden convinced this part of the population. I think that's, I don't know if you agree with me about this fact, Jay, about the capability of Biden to convince the Trump part of the Americans.
Yeah, I mean, I think, Jacques, that it's probably not going to be President Biden who convinces the folks who are anti-vaxxers. I mean, it is, a reality in many developed countries and emerging countries that there are a segment who don't believe in vaccinations even before COVID. I think what's going to be a much more important driver is the private sector requiring vaccinations for people to do different things. If you want to travel, if you want to attend a sporting event, if you want to go to school next fall, a number of schools in the United States have already said they're going to require vaccinations. And that is something, I don't think the government in the US will mandate a mandatory vaccination. I think that would be problematic. I think what's going to happen is the private sector is going to drive it. And those folks who don't want to get vaccinated will be limited in the things that they can do. And I think that's perfectly fine.
This is my main concern, to be honest. It's this map. There are two sides of this map. The good thing is that we are in Occident close to the herd immunity each day. Okay, the issue is that it's not the same page for the emerging countries. Mainly in China, it's always difficult. This map is coming from one world. Our world in data is a website run by Oxford, and definitely the situation of figures is not very clear for China, and we know the situation in India. Definitely, the Occident is quite in good shape, but it's not the case for the emerging countries. Unfortunately for us, this pandemic is global.
Yeah, I mean, I think that's true, but from a market perspective, I would think that's becoming less and less important to the market. I think, and I believe correctly, that financial markets have basically discounted the end of COVID insofar as it's the main driving factor in markets. And I think if you look at places like Brazil in particular, and perhaps India as well, the headlines are horrible, and the cases and COVID, et cetera, horrible. Yeah. But the reality is that the currency is appreciating and the stock market's going up. And that is telling you that the market has fully discounted all of this and sees a future that is a win, not if, in terms of better news on COVID. And so, to me, I think all these issues are correct, but from a market perspective, I think they're becoming less and less important.
This is quite a relevant point. This is why our question at the beginning of this webinar, it was, what is pricing? Because definitely, okay, if the current situation is not very a concern, it's definitely that meaning that markets are pricing something better, definitely. Now, where we are in transition in terms of global economic cycle, it just I pass very quickly on these different charts. It's just the percentage of personal income made by government transfer is just huge in states. Okay, it's not a communism country, but it's roughly 25 to 30%. And I think we will get back on this point when we talk about the NFP. I think that it's very, important to keep this in mind. We are, it's historical, this kind of inflow coming from government transfer or assistance payments. It's quite amazing.
Jacques, sorry, Jacques, just to interject, are you scrolling through your charts or not? Because I just see on my screen the cover page of your presentation. I don't know if I know you're talking to some of these charts. Are you actually scrolling them up? Because they're not showing up on my screen.
Okay, 2 seconds. No. Okay, seconds. I change that.
Yeah, there you go.
You see?
Yep, exactly. I just wanted to let you know that they weren't showing up on the main screen.
2 seconds. 2 seconds. I will do this. Okay, you see this?
Yep. Yes, I see it now. Perfect.
Okay, and this. Okay, better?
Yep, perfect.
Okay. Cool. Okay, I'm sorry because I showed this. Okay, for the vaccination, the map is there. Now we are there. Okay.
Perfect.
Okay, and now the turning point in inflation. Okay, it's just in the US we are already seeing some inflation points. My conviction is that the most part of the inflation is coming from Asia, we could discuss together about that. Japan and European Union is still in discussion in war. It's I don't know if you have some stuff to discuss about that at this stage, but it's
yeah, I mean, I would make a couple of quick points. I mean, I do think inflation is again very well expected. I think the markets, and we've touched on this, I think, in our last webinar, Jacques. I think markets have sped up the discounting process, whether it's because of advances in technology and machine learning, whether it's COVID speed. But to me, inflation is already priced into the U.S. Financial markets. And we'll get a taste of that on Wednesday when the CPI for April comes out. It's expected to be about 3.6% on the headline number. That's way above what we've seen for the last couple of years. I expect the markets to not really pay that much attention to it, but nonetheless, it's going to be a good big test of that thesis. And I agree completely on Asia. I mean, if you look at China's yuan, you note that it's the strongest it's been in years, and that's providing upside opportunity for everyone who competes with China and is therefore somewhat inflationary, which to me is a good thing.
Okay, it's but I will dig more in details about my vision about the inflation, but I think that the inflation will not be transitory, like you mentioned, power on yen, but we will discuss about that together. Okay, bull run in economy, I think is very clear. It's the map. It's talking by itself, except it's some 3 countries. Everything is full green, on many times more than 6% of GDP growth. I think that it would be interesting to have your view about this chart. It's about the earnings season. I think it's the earnings season was quite amazing. We learned also, plenty of companies just mentioned that they will raise their share buyback massively on the amount just stratospheric. What is your comments about this kind of bullish environment?
Well, I think it's a real factor as why markets are continuing to gradually appreciate, is that you do have very strong earnings. I would say, first of all, you have very strong breadth in equities, both in terms of within the US, 70% of stocks are above their 200-day, as well as globally, about 70, 80% of the countries covered are also above their 200-day. So very strong breadth brought about by both growth stocks doing well, at least in terms of earnings, as well as the value and cyclical sector starting to perform. And so I'd make just 2 quick points. One, you show the US, but I think it's really important to note that Europe's earnings have been way better than expected. I think up about 50% year over year and well above expectations. And the result of that is that not only are US earnings doing well, Europe's earnings doing well. So again, don't invest on headlines about COVID and lockdowns, invest on what's actually going on with companies. And then secondly, I would say that it's now pushing analysts to upgrade 2022. And in the US, I've seen already estimates for 2022 at about $250, which if you do the math, 4,200 on the S&P divided by 250, that puts the S&P at less than 17 times next year's earnings. And so all this talk about bubbles and expensive markets and everything is just completely wrong.
Okay, very smart comments on this is why we are for Get Advisory, the US, the investment in US assets. It's just needed now, even if I am just more barbell, I should say, because we could have some surprise perhaps in the summer, but we get back on that. After, in terms of where we are in the global economic cycle, I just want to design and show with this graph that the demography is quite important. We have a huge, after the census in the US, there is a major shift of the very center from the north, the rusty belt to the sunny belt in terms of population. And of course, the consequence will be also a shift in the parliament in the US. Do you think that's a cool change some stuff in terms of economical figures or in some aspects to see this kind of change in buying center in the US with more population?
Yeah, I think that's, yes, I think that's a key point, Jacques, and I'm glad you brought it up because, you know, one of the issues that's bedeviled the US has been kind of inequality as well geographically, so that the coasts, the East Coast with finance and the West Coast with technology have done really well over the last 20 years. You see that with, you know, New York, where I'm sitting now, or San Francisco. And going forward, I think we are going to see kind of a broadening out, and increasingly with the understanding that you can work remotely, and this, you know, drive for the millennials to get housing and to start families. There's a lot of things going on that suggest that U.S. Economic prosperity might be more evenly distributed throughout the country. And of course, that's a big part of what the Biden administration is trying to drive to. It makes good sense economically. It also makes very good sense politically. And so I expect that to be a fairly important factor in the coming decade, you know, 1 or 2 decades. And to do that, you need good infrastructure. So all this fits together with the Biden administration's plans about, you know, driving equality, fixing infrastructure, and removing U.S. success away from the coast towards the entire country.
Totally agree with you. After the second chart it's just a map, okay, on it's quite important. If you want to understand as an investor how the inflation is spreading, okay, this is a quite relevant chart, okay. It just all the dots, okay, are demonstrate the China exports quantity. In each dot in the map there is just where the Chinese steel is exported. That's why, as I mentioned many times, the PPI, the Chinese PPI is the global CPI. But if you want a demonstration about what I'm saying, is this map. Okay, and I think it's crucial to keep this in mind, to be focused really what's happening about the inflation in China, on my view.
I agree.
After I would like to finish the state of the global economy cycle where we are with again the demography, but in China. Very quickly, I read plenty of newspaper articles or researches saying, hey guys, the first time since 1949, the population in China has declined. Okay, it's hugely deflationary. Guys, if you look in details, it's wrong. Why is wrong? Because the part of the Chinese population in countryside is just massive if you compare to the other countries. It's just 80% in the US, it's 35% in China, meaning that currently we have a huge move of populations from the countryside to cities in China. One farmer don't generate the same share of GDP than a man or woman in cities, meaning that the generator per capita of GDP is massively higher in city than in countryside. This move of population is so massive in China, and China is so late in this cycle of kind of urbanization, okay, that it will compensate massively any drop of the population. I highlighted this in the second chart with the share of the industrial sector in China. Even in 2050, okay, at 32.2% of the GDP will be created by industry. In the US currently, it's there is 18%. Okay, that's why I think that there is no way that any drop of the population in China will be deflationary. I think it's the clear demonstration that it will happen through this demographic move. Now, I think that we are in the state of the transition. I just put different kind of stuff. Some are scary, and some other not. And I don't. I think that, guys, you can see all these items. I would just stop on 2 or 3. Infrastructure plan is just a prerequisite. Is fine for me. Just an investment thematic. It's a massive investment thematic. But the tax regime is changing. What is your view about the tax changing in states? It's not a big deal, or it's could change some investment interest?
Yeah, no, I think it's, I think the Biden administration is trying to kind of thread the needle, right, between what will be funded by borrowing and what will be funded by tax increases. Yeah. And I think they've done a pretty good job so far, because the bond market's pretty calm at 1.6%. The stock market's at new all-time highs. So that would suggest to you that people are pretty confident and comfortable with what has been proposed. And I think there's just a recognition that over the last decade, as we know from the great financial crisis on, capital has done really, really well. And it's been primarily because the Fed was the actor that drove policy. And so investors have done phenomenally well over the last decade. The wealthy have done phenomenally well. And now it's time to spread that out a little bit. And I would just make the point that the capital gains tax, which has gotten a lot of attention, it kicks in after you have $1 million as an individual in capital gains. So, you know, that's a very small number of people. And I would think for most investors, it's meaningless. The other point I would make is it does reinforce the ETF instrument, Jacques, at least in the United States, much more tax efficient than mutual funds. I think you're starting to see that. That's another rationale for more ETFs. And it reinforces, in my view, the focus on thematic investing, because if you're focused on a theme, then you are focused on something that's going to play out over years in a secular basis. And therefore, to me, this all just suggests that the approach that we've taken here at TPW, focus 100% on ETFs, big focus on thematic investing within a global macro outlook, is actually being reinforced by some of the measures the president's suggesting.
Yeah, but we are the same approach in Gate Advisory, but it's I think it's a rare point. What I would like, my point to when the other point is items, it's just was to highlight the regulation start to bite, I should say, our environment. It's not scary at this stage, but when I'm seeing what has been on the stocks, the IPO ETF is dropping massively. We have the US Treasury still start to be concerned by the money laundering using crypto. There is some transition, I think I should say, in the regulations. Do you think that it could become more nasty in the coming months?
You know, I don't really have a strong view on that. I mean, I think regulatory pressures are going to be something that we're going to be hearing about, you know, going forward. I think we were probably in a period of kind of lax regulation in the last administration. And going forward with crypto and fintech and traditional banking, I do believe that the melding of those three is a really important theme. And so we'll probably see more on that, the issue of SPACs and things of this nature. But to me, really, the important point is that markets are driving in ways that allow investors to get into new innovation earlier than historically has been the case. When you have SPACs bringing companies public, these are companies that traditionally would not come public through the traditional IPO route. And therefore, it's risky. Some of them will not do well. Some of them will do very well. And so in a way, the public market investor, as I see it, is actually getting opportunity, which heretofore has been the province of the VC investor in the private equity space. And so to me, the question is not so much, is there a bubble in public market activity, but more, is the bubble in private? because there's so much money focusing on this space. And you see it with Coinbase's IPO, right? Tremendous enthusiasm, tremendous excitement. Coinbase is down 30% from its IPO, suggesting that the misvaluation, the mispricing was in the private space, not in the public space.
I will be more balanced, I should say, on my side. Just that, of course, the dry powder is just massive. Of course, on valuation, as just insane, I should say. But definitely, you know, it's in terms of asset allocation, okay. Except the on-demand funds, the weightings of the private equity is quite small for institutionals, for example, even pension funds in many outside states. Okay, I think that's just the beginning of a new era where we could have some asset allocation more balanced between the listed, mainly in ETFs, I should say, on the private equity. And I think it's this dry powder where we find this way to catch some real future champion of our economies. But of course, this in transition, perhaps we have some exaggeration, but it just to highlight my point, it just the last item I put on this page is that the MSCI World is 20% above its 40 days moving average. Okay, on the VIX is 40% below the same average, meaning that we have a huge all-in, huge complacency, whatever, or perhaps for the good things, but I think that's the exaggeration. If there is in the private equity, we already have some, in some way, a kind of, I think not scary, but I think we should take care about what will happen in the coming months, just to be bubble, just to, as you mentioned, there are plenty of good news or plenty of good hope for the future. And I think that the US equities and the US assets need to be on the front. But after the volatility is cheap, I think that we have to take this in mind, because the spread is just historical. Now the state of the markets, it just not your view, but it's my view. I put this cartoon because I love this cartoon. For me, it's what's happening now in the market. Okay, you want to see, you want to hear, you want to talk, just buy, boom, and after, okay, we pray and move on. But it's my expression of what I'm thinking. Money is dirty cheap. Dirty cheap, I think it's obvious to say that. Okay. Now, I would love to hear you about this point. We talk a little bit about the NFP, okay? Now, our view in Get Advisory is, okay, is the figures were disappointed massively, roughly between the figures for April on the revisions of figures in March, we were close to 1 million gap, just massive. By some ways, it could be good for Biden's plan. It's good for the deflationary calls. Powell, Yellen, liquidity binge could continue for our life, perhaps, I don't know. What is your view about this kind of figures?
Well, I think it was clearly a surprise, but markets reacted pretty impressively, both in the debt and equity. I mean, I think where you saw probably something of interest was in the dollar, where the dollar was quite weak and gold was reasonably strong. So, you know, in my view, I don't really buy the argument that this is because people are being paid $300 a week in unemployment insurance, that's why they're not working. I think if you look at the sector that generated the most jobs was the leisure and hospitality sector, which had 300,000 new jobs, and those are the low wage paying jobs. So I think that argument falls flat on its face. It's politically inspired. I think really the issue is that we're in a kind of choppy period of reopening, and I envision that as the months go forward, we're going to see much stronger job gains. And, it may be that it's going to take a little bit longer, which, as you say, and I think correctly, it puts the Fed, or not the Fed, because I think the Fed is on hold. The Fed has been very clear it's going to wait until it sees the data. And so I think it puts the markets on hold in terms of people trying to make the case that the Fed is going to be forced to act sooner and get behind the curve, et cetera, et cetera. That's never been my view. My view is that the testing time is going to come late summer when we get clean inflation readings. Also, you'll have more jobs numbers. You'll have May and June. So I'm looking at kind of the Jackson Hole period in August when the Fed will be talking. You'll have thin markets. You'll have poor seasonality. And you'll have better sense of what happens after we get through the COVID-inspired inflation, mechanical inflation that we're going to see, for example, on Wednesday at 3.6% headline number or higher. I think that's when we can really get a sense. To me, the risk is not when numbers are all over the place. The risk is going to be once we normalize numbers and people are going to be able to see, has all this spending been able to project us onto a higher growth path, or are we going to go back to the 2% type growth that we've had since the financial crisis in 2009, 2010? That's when I think we'll have the quote unquote testing time.
Yeah, and one of I'm questioning the figures about one thing. So I'm not like you. I'm not believing that stay at home is the mindset in the US. Okay, definitely it's more likely in Eurozone, but definitely it's. What I'm afraid a little bit is between the dichotomy between the supply and demand in terms of skills. I read plenty of comments from top management during the earnings of companies there are difficulties to find the right people with the right skill for the job, and there is kind of dichotomy between the type of jobs, okay, on the skills of people looking for jobs. I hope that's just transitory for one time, but because definitely in digitalization we are more and more. I think this image, I think it's not the reality, but it's just to depict what I'm thinking. We are looking for plenty of guys or women able to generate code in Python, but we have plenty of people are just they have not the right education about that. Or in digitalization world, what will happen about all the part of the society was not the right skills for the new kind of jobs, okay? Perhaps these kind of figures surprise us, even surprise some guys from the Fed, because some Fed members just forecasted 1 million jobs created, okay? And perhaps there is a nasty movement in the unemployment environment in the States between this kind of divergence between the supply and the demand. What do you think about that?
I think there's probably something to it because we are, moving very, very rapidly at COVID speed, and I do think the digitalization of everything is an issue. Also, an issue for inflation. I struggle, for example, to see how embedded inflation is going to really take off in the United States when you have the digitalization of everything, which is by definition, and we've seen historically, is deflationary. So that's one of my big pushbacks on the idea that we're going to have entrenched inflation coming out of this because of all the money printing. The other point simply is that the velocity of money is completely collapsed. And so if the money's not moving, it's not inflationary. But in terms of the imbalance, I mean, I think that's, again, if you look at one of the president's proposals, it's a effort to make 2 years of community college free for all citizens of the United States. That's one of the ways you get a workforce better attuned for the modern needs of a technologically driven economy. And so I think these are the things that this is going to take time, though, and it's going to be unfolding over a period of years. I don't think it's going to be something that's going to create, for example, massive wage inflation that's going to lead to, again, inflation that puts the Fed behind the curve, and then we get, rapid rising interest rates and a crash in the stock market. I mean, I think that's very far from being likely.
We talk about the rotation between sectors or style. It's just it is in this, and we talk about our concerns regarding Nasdaq. We were right, because definitely the Nasdaq underperformed the S&P on the Dow Jones. On the top of this page, we have kind of interesting charts. The European stocks, okay, where when ISM just peak, we have an overperformance over 1 month about cyclicals, but after defensive our defensive are overperforming. What is your view about this after the NFP? Do you think the Nasdaq will back to traction? Do you think the opposite, that we could continue to catch some defensive name for the summer? What is your view about that?
Yeah, no, this is markets are definitely kind of tricky. I mean, part of what I mentioned earlier is the fact that we have like a twin engine market, right? When in some periods of time, when rates are going up, it's all cyclical in value. When rates are softening, as we've seen in the last month or two, you had a bid for the growth stocks in the Nasdaq, and the two of them combine to support a market that moves higher. My own view is that we are approaching the kind of developed market reopening. So not just in the United States, but also in Europe. Europe's going to be behind the US in vaccinating the majority of its population by like a month. So I think we're going to have a developed market reopening, not really the EM as we touched on. I think that's going to lead to higher interest rates, both in the United States and in Europe. I think the 10-year Bund, for example, could trade above zero. Now it's at minus 20 basis points. And I think that leads to a second leg of the rotation to non-US equity, to value, to cyclicals, to small caps, et cetera. And so in that environment, I think the opportunity is going to be really in the laggard markets, and particularly in places like Japan, which really hasn't performed, in Latin America, which is very tied to the commodity cycle, but has not performed in line with the commodity rebound, which has been a very aggressive one.
And we just perfect transition.
Did you like that? I knew this slide was coming.
Amazing. We talk about the Como hyper cycle. Okay, on this chart, it's over 20 years. Okay, when you see that, okay, where is the hyper cycle of Como? Okay, is it the Como is I put the S&P Goldman Sachs Como index. Okay, when I see this chart, okay, we are far of an hyper cycle. Now, if we have the same indices, but from November 2020 is not the same page at all.
Yeah.
I think it's important. I think we're on the same page together. That's why I'm always concerned about if we think that we are started to at the start of any hyper cycle in Comos. I think that to be deflationary is complicated, I should say. But anyway, what do you thought about the Comos, the Como hyper cycle?
Yeah, no, I think you're spot on. Great charts. I would just suggest that one of the other charts is really that's really telling is Latin American equities, and particularly Brazilian equities versus the commodity cycle in the past. Typically, they correlate very highly. And in this cycle, the one you're just showing from November on, it's not the case at all. So one of the things, we update our model portfolio. We provide model portfolio delivery services at TPW Advisory, and we update on a monthly basis. And last week was the update. And one of the things we did was we really trimmed back some of the kind of broad brush thematic names, and we added to the commodity sector across both debt and equity. And I'm very bullish on commodities. And I think what's kind of interesting, Jacques, is that the focus on ESG, which is the main focus for many, many big pools of money, is actually likely to extend this commodity cycle because banks and others are being pushed by the ESG folks to not lend to mining and oil and energy exploration and development projects. And so as a result, you have a situation where we're going to exhaust the existing supply across a number of minerals. For example, lithium. The main focus in the US and Europe is on transportation-related emissions. Those are the biggest emitters. And I read just over the weekend that the International Energy Agency said that in order to meet the Paris Accord targets, the demand for lithium is going to go up 40-fold. Yeah. So 40 times, not 40%, 40 times. And you have a similar situation with copper, where supplies in terms of new supply coming on the market is only 2% of existing supply over the next couple of years, versus in 2010, it was 12% coming out of the great financial crisis. So to me, the opportunities in commodities are broad, whether you talk about oil, gold, whether you talk about carbon as a commodity, which I think there's going to be increasing focus on carbon border adjustment mechanisms, perhaps between the US and Europe, whether you talk about lithium, copper, et cetera. So as you point out, in the near term, yes, they've had quite a move, but the number of people who are invested in commodities after, go back to this chart, yeah, I mean, nobody's there. This is the beginning. I think we're in the first inning or two. And so my musings, I write every Friday, I write a Friday musings, and my title last Friday was "Commodities Are the Boss." And they are the boss. They're leading. They're the best performing asset. And, the number of people invested in them are very, very small. The last point I would mention, I think it's really important, is that I do think there is going to be an interesting kind of combination of physical price pressures through the commodities, offset by the digitalization of everything, deflationary tendency. And so my view is that these are probably going to be a wash. So you are able to make money in the commodities and you don't have to worry about high inflation, because it's not the 70s. In the 70s, we didn't have digitalization. We have digitalization in the 2020s. And really the last point, sorry, and I'll stop. This is a theme I'm very focused on, as you can tell, is I think you can make money as an investor in carbon, right? So you want to price carbon appropriately to bring down emissions, to incentivize people to bring down emissions, so you can make money in carbon. You can also make money in metals and mining. And so again, it's this opportunity when you invest thematically to play both sides, as we did last fall, when we made the point you can make money in old energy, like the oil majors, XLE, and new energy, ICON. That worked out phenomenally well for the second half of last year. I now think for this year, it's carbon plus mining and metals.
Yeah, it's I'm more concerned about inflation. My stance about that, because definitely, even if digitalization is quite massive, even in semiconductor, we have kind of bottlenecks. The digitalization, just the acceleration of the digitalization was so quick. Now we to build a semiconductor plant, we need two years, meaning that the current bottlenecks is there to last. And definitely, we could have also some inflation in this deflationary our sector. It's my view. We will see in the coming weeks and months about the price of semiconductors. But definitely agree with you. In Get Advisory, we will launch a decarbonization, China decarbonization strategy. That's why I'm really aligned with you on the hydrogen too. I'm fully convinced I'm really aligned with what you say. Now we go to thematic. Definitely now the thematic ETF just are skyrocketing in terms of asset under management. Is the same for the global thematic fund also. I think that's the chart is quite clear. In terms of exposure, in terms of style, of course, all the growth style is quite well represented in the most well-known thematic like digital economy, millennials, auto tech, and so on. That's why I think it's important for investors to capture the real exposure of the thematic. Sometimes some ETF are not quite transparent about what are the real exposure in terms of style investments. I don't want to talk about here about the ARK investment ETF, but I have really huge concern about this kind of setup. But definitely, I think it's important to have a look under the hood on just to say, guys, okay, what is your exposure? Because meaning is what are our risk in the investments. On this chart is quite interesting in terms of style exposure. And now, just to finish the thematic, it's not. I think there are perhaps more than that. Okay, for me, I just select 7 thematics. The inflation, for me, it's quite important because some supply chains are quite distorted. Asia is a source of inflation. We will see in the coming days. If the CPI in US is important, the tomorrow morning the CPI in China will be, and PPI in China will be very important also in terms of perspective in the inflations. Cybersecurity, after the colonial issue, I think that it's quite relevant. Decarbonization, the cost is 1.5 trillion only for China. I think it's always a question of cost. Okay, I think that's I want to express this to all people we look this video. It's just to when you think about thematic, think about cost for countries, for the economies, and so on. Sometimes it's a good mindset to have to try to catch up some thematic, okay? Because of course the states will try to tackle this issue when the costs are beginning to important. And definitely, decarbonization is one, cybersecurity is one, costs are above 2 trillion. Blockchain, it's we have no time to dig about that, but space UTC, I think it's quite relevant, but more in private equity. Hydrogen. After questions about the growth cycle versus value defensive, in this kind of map of thematic, what is your thoughts? Do you think there are other thematic to point out?
No, I think you covered a good ground, and you showed the MSCI screen before, and they have, I think, 16 thematics that they've identified. Yeah. A lot of them around wellness and other things. I mean, to me, if you go back to your slide, there you go. The one I'd say a couple of things. One, I have read that the total addressable market, or TAM, for meeting the carbon goals of 2030 is somewhere around $115 trillion globally. Yeah. So over the coming decade. So for sure, investors need to be very, very focused on that. I also think, as I've mentioned, the melding of traditional banking, fintech, and crypto is also a really important area to kind of have some thoughts on and to be participating in different ways. And so that's a second. And then the third is the broad clean energy approach, whether it's electric vehicles or batteries, or we've made an investment into the uranium because just as I mentioned earlier, the West, US and Europe is focused on transportation emissions. In the East, in Asia, in Japan, and in Europe, in China in particular, it's power generation that is the big emitter. And so I do think uranium, I do think nuclear power is going to be an issue, an opportunity in Asia to kind of deal with their challenges in getting to meet the carbon reduction efforts. So to me, I think you've covered a great bit of it. And third, I would say is cyber. I'm actually surprised. I just saw the open in the US before we got on the call here. And a couple of the cybersecurity ETFs actually traded down, which I would have thought would have been, they would have been up big given the Colonial Pipeline ransom attack. But I do think as we go to the digitalization of everything, then cybersecurity becomes a much, much bigger market, and therefore, again, an opportunity for investors. So for me, really the issue with thematics, Jacques, is, I think we both look at things fairly similar. We're both global, we're both macro, we're both multi-asset. And so how do you fit thematic exposure into a global multi-asset portfolio, which is focused, at least in our case, 100% ETF focus? That's really the challenge. And so I think a lot of it is positioning, a lot of it is sizing. And so one of the things we did, as I mentioned, is we reduced our exposure to kind of the broad growth thematic ETFs, and we focused in more on some of these issues that deal with the carbon issue, deal with uranium, deal with cyber. We added to our cybersecurity holding, for example. And so to us, this is really the balance of our approach. And I think you will have big opportunities in the thematic space. You don't know exactly when they're going to unfold, but as investors, I think you need to participate. And so in order to not be shaken out when you have periods of volatility, you need to size them appropriately. And then we're right about it now. Right about 20% of our model portfolio is expressed via thematics.
Yeah, this is for us. It's a core satellite allocation. I think that's when the market is ramping up, and we are less fuel in pure beta environment. Already is easier to manage the beta through ETF allocation by allocation in ETFs. I think that's and when we can design thematic with a real added value in terms of constructions. Like, for example, you mentioned uranium, but in our decarbonization, Chinese decarbonization thematic, we already put inside all the nuclear power plant and so on and so on. I think it's like our US infrastructure thematic. Definitely, we started to integrate I should say cyber security, inside. And I think that it's the kind of new way of thinking about thematic. And if we are not able to have this kind of allocation, it's better to buy ETFs, roughly. Okay, but I think that's when we have kind of specificities or granularity in particular thematic. I think it's quite relevant to issue some dedicated vehicles just to implement this kind of stuff, like a satellite around the core.
Yeah, and I think that makes perfect sense, and that it's a great, that's why clients could be clients of both GATE and TPW, because you construct specific certificates, and we don't do that. We focus on the public ETFs that are available, but I think you've just made the case very well for the rationale to have both or to be exposed to both. And I think that makes perfect sense. And I admire and impressed by some of the thematics that you've created. You've shared them with me previously, and I think they're really exciting stuff. So I think it's great stuff, and it's something that investors need to really pay attention to. And the fact that just a quick statistic to tell you where we are in this process, Jacques. In the U.S., ETFs represent about $6 trillion in assets. thematic ETFs represent 500 billion.
Yes.
So a tiny, tiny, tiny fraction of the money that's invested in ETFs are in thematic. So the opportunity set here, whether you're creating specific thematic sleeves that you're doing or investing via the public market ETFs in thematics as we're doing, I think the opportunity set is going to be fantastic in the next couple of years.
Thank you very much. I appreciate our collaboration. Katrina, I'm sorry because I have a meeting now, and I think for questions could be tricky. I think that it would be interesting if you have some. You can collate the questions, or we will revert to the person just by writing. I think it's better.
Yes, okay, great. No problem. Actually, I think tomorrow our webinar will be online as well. And if you have any questions, you can always ask them via Quantilia or Gate Advisory. Yes. So we are open to answer them, of course. And
sometimes the schedule are just for thanks you for your collaborations. Thank you, Katrina, to hosting us.
Thank you, Jay. Thank you, Jacques. It was a pleasure as always.
Thank you, folks. It was great.
Have a great day.
You.
Bye.
Bye-bye.
Bye-bye, everyone.
Safe and sound.
Till next time. Bye-bye.
Till next time, sure. Have a great day.
With the right timing, trust me.
Thank you.
Ciao.
Bye-bye.